All right, welcome to The Explainer. Today, we're going to tackle something that, honestly, blindsides a ton of real estate investors. It's called depreciation recapture, and it has a nasty habit of turning a great sale into a painful tax season. So picture this. You sold your rental property, you did the math, and the profit looks fantastic. But then the tax bill shows up and, whoa, it's way, way higher than you planned for. This is a super common story, and we're about to find out exactly why it happens. Okay, so where in the world does this surprise tax bill even come from? Well, here's the crazy part. The root of the problem isn't some kind of penalty. It actually starts with a tax benefit that you've probably been enjoying for years. And that benefit is depreciation. You know, the one where the IRS lets you deduct a little piece of your property's value from your rental income every single year. It's a fantastic tax shield, right? It boosts your cash flow while you're holding on to the property. But, and this is the big but, the IRS never meant for those savings to be a permanent gift. The best way to think about it is like an interest-free loan they give you. And when you sell that property, it's time to pay the loan back. So how does the IRS collect on this so-called loan? This is where we meet the main character of our story today, depreciation recapture. It's the mechanism they use to get that money back. When you sell, the IRS basically takes your total profit and splits it into two buckets. The first bucket holds your actual profit, the appreciation. The second bucket, that one holds all the depreciation you claimed over the years. And it's that second bucket that the IRS wants to recapture. All right, let's get into the numbers. And don't worry, the math might look a little intimidating at first, but I promise it's actually a pretty logical step-by-step process. It really just boils down to 3 steps. First, we have to figure out the property's new cost basis after all that depreciation. Second, what did you actually walk away with after selling costs? And third, we calculate the total gain and then pull out that recapture amount. Let's walk through an example here. Notice how that $87,000 you took in depreciation gets subtracted from your original purchase price. This gives you a much lower adjusted basis. And here's the key. A lower basis is what creates a bigger taxable gain when you go to sell. Now here is the really, really important part. That total gain of over $223,000, it's not taxed as one big chunk. It gets split. The amount you depreciated is one piece of the pie, and the actual market appreciation is the other. This little separation is everything, because each piece gets taxed differently. And why does that split matter so much to your wallet? Because you guessed it, the IRS does not tax those two slices of the pie at the same rate. This number right here is the whole reason we're talking about this today. Your recaptured depreciation is taxed at a special rate, and it maxes out at 25%, and that's almost always a higher rate than you'll pay on the rest of your profit. And here it is, side by side. This is the aha moment. Your normal profit from the property's value going up, that's a long-term capital gain, taxed at rates that top out at 20%. But the part from depreciation gets hit with that higher 25% rate. That 5-point difference is exactly where the shock in your tax bill comes from. Now you might be thinking, aha, I'll just not claim the depreciation. Well, bad news. The IRS has what's called the allowed or allowable rule. It means they're going to tax you on the depreciation you were allowed to take, whether you actually took the deduction or not. So yeah, there's no escaping it. Okay, I know that sounds a little bleak, but the good news is you're not powerless here. Now that you know this tax bill is coming, you can actually plan ahead. There is some really smart, established strategies to manage, minimize, or even just defer this tax hit. So what are your options? Well, the most popular tool by far is the 1031 exchange. It lets you kick the can down the road by rolling the entire gain into a new property. But you could also consider an installment sale to spread the tax out, or maybe time the sale for a year when your income is lower. You can even use estate planning to potentially eliminate the tax for your heirs. And just a few final details to keep in mind. Don't forget that any major improvements you depreciated, like a new roof or an HVAC system, are also subject to recapture. Also, if you lived in the property for a while, that doesn't erase the recapture from its rental period. And of course, remember your state might want its own piece of the action too. So if you remember just one thing from all this, let it be this. Depreciation is a fantastic tool while you own the property, but it is not a gift, it's a deferral. And the recapture, that's simply the tax bill finally arriving.
Thinking about this upfront, before you even think about selling, is what separates a savvy investor from one who gets caught by surprise. Being aware of recapture means you can plan your exit just as carefully as you planned your purchase. And that is how you keep more of your hard-earned profit in your pocket.